50%. That's the number that sent a massive shockwave from Washington, D.C. straight to New Delhi, and it's threatening to completely upend a trade relationship worth billions of dollars. Now, this is way more than just a political headline. It's a huge economic event, with ripples that could affect everything from the jewelry you buy to the stability of the entire stock market. So in this explainer, we're going to break down exactly what happened, who's getting hit the hardest, and what it all means for the future.
All right, so here's our game plan. We're going to start with the tariff itself, the main event. Then we'll follow that shock wave as it smacks into India's exporters and the wider economy. After that, we'll dive into what India is doing about it, its global plan B, and we'll wrap it all up with what this could mean for you, especially if you're an investor trying to figure all this out.
So first things first, let's just unpack the event that started it all. The U.S. dropping this bombshell of a new tariff on Indian goods. This move basically puts India right up there with the most heavily tariffed trading partners of the U.S.
50%. That is the number that has absolutely everyone talking. And just to put that into perspective for you, this new rate is actually higher than the one for China, and it's right on par with Brazil. Some analysts are even saying it's basically like a trade embargo because it's designed to make Indian products so expensive that nobody in the U.S. can afford to buy them.
So what even is a tariff, really? Well, simply put, it's a tax on stuff that's imported. But look, when that tax suddenly jumps to a crazy 50%, it's not just some line item on an invoice anymore. It becomes this massive wall, a fundamental barrier that basically just slams the door shut on a whole lot of businesses.
And here's the thing. This didn't just happen overnight. It was a 1-2 punch. First, a 25% base tariff hit on August 7th. Then, just 20 days later, bam, another 25% penalty on top of that. And the official reason Washington gave for such a drastic move? They pointed directly to India's ongoing trade with Russia for oil and defense equipment.
So naturally, the first and most powerful ripple from this whole thing hits the folks right on the front line, India's exporters. And this is especially tough for the small and medium-sized businesses that are, the real backbone of so many of these industries.
And you can see right here just how exposed some of these sectors are. I mean, textiles and apparel, they send a full third of all their exports to the U.S. And the gem and jewelry trade is worth $11 billion a year. So for industries like these, which are often running on pretty thin margins to begin with, a 50% tariff isn't just a challenge, it's an existential threat.
And behind these big numbers, there's a very real human cost. We're talking about an estimated 125,000 jobs that are at immediate risk, and that's just in the gem and jewelry sector alone. These are highly skilled artisans, people in cities like Surat and Mumbai, whose entire livelihoods depend on that export market. The banking expert Ajay Bagga put it perfectly. He said there's a tipping point. Once a tariff gets this high, the exact percentage almost doesn't even matter anymore. It's not about negotiating a better price, it's a complete shutdown. In fact, we're already hearing that American buyers are just halting all new orders. Full stop.
Okay, so from the factory floor, that shockwave, it just keeps spreading out. It inevitably shakes up the stock market and the broader economy. And what we're seeing there is this weird mix of deep anxiety on one hand, but surprising resilience on the other.
Economists are definitely sounding the alarm. This tariff shock could end up shaving as much as 0.4% off of India's GDP growth for the whole fiscal year. Now, for an economy that's aiming for about 6.5% growth, that is a pretty significant headwind.
So this has created this really fascinating tug-of-war in the markets. On one side, you've got this resilience. The Indian rupee has held surprisingly stable, thanks in part to the central bank stepping in. But on the other side, there is some serious anxiety. Foreign investors, they've already pulled over $4 billion out of the market as these tensions have been building.
And you can see that conflict playing out right here, just on a single day. Foreign institutional investors, the FIIs, they sold off almost 5,000 crore rupees worth of shares. But look at this. At the very same time, domestic institutional investors, the DIIs, they stepped in and bought even more, basically propping up the market and stopping it from taking a major tumble.
So, is India just sitting back and taking this shock? No way. It's activating a global plan B,
a whole strategic response that's really designed to cut its dependency on any one single trading partner.
And this isn't just about one single move. It's a complete strategic pivot. The government and industry are doubling down on strengthening domestic manufacturing through the Make in India initiative. At the same time, they're aggressively hunting for new places to sell their goods. Fast-tracking trade deals with places like the EU and Southeast Asian nations. That's a top priority now. And it's all part of this bigger play to position India as the go-to alternative in that China Plus One strategy that you hear so much about.
And here's a really crucial point. India isn't going at this alone. This isn't just some two-way spat. You've got major economies like China, Brazil, and even America's neighbor Canada all pushing back against these US policies. This could really be the start of a whole coalition of nations looking for a different kind of global trade order.
Okay, so we've looked at the shock, the impact, and the big response. Let's bring it all home. What are the key takeaways for you, an investor, just trying to navigate these pretty choppy economic waters?
So what's the advice from the experts? Well, for a lot of them, it boils down to a pretty clear three-step approach for your portfolio. First, focus on sectors that are driven by the domestic economy. Things like banking and telecom, which are more insulated from all this. Second, be really cautious with companies that rely heavily on US exports. And third, keep your eyes open for opportunities. A big dip in the market could be a golden chance to buy some quality stocks at a discount.
Now, it is really important to note that not every sector is in the line of fire here. It looks like there are some safe havens, at least for now. Key industries like pharmaceuticals and IT services, which are both huge export earners for India, have actually been exempted from these tariffs. And that provides a really crucial buffer for the economy and maybe some stability for investors.
And all of this leaves us with the big final question, doesn't it? Are we just watching a temporary, high-stakes political drama that's going to get sorted out through negotiations in a few weeks? Or are we witnessing the beginning of a fundamental shift, a complete redrawing of the global trade map, where old alliances get tested and a brand new economic reality starts to take hold? The answer to that is going to shape economies for years to come.